All right. Happy Monday morning or afternoon or evening, whenever you're watching, wherever you're watching. I'm here. I'm Matt Gouget with UMortgage. I've got Nash Paradise, the Loan Wizard, and just a quick hit on what we're going to cover today. We're going to talk about the Fed meeting last week. We'll recap that and talk about how that may have affected the market. We'll talk about the inflation data and the effect that had on the market. It was an eerily quiet week for mortgage bonds last week. So we'll look at that. We'll look forward. I think we can even talk about tariff headlines and what's going on with tariffs and how that might affect our world. So back from his trip to urgent care now, care later, whatever you want to call it. Thanks for joining me today, Mr. Nash Paradise. How you doing, brother?
Doing all right. On the way up, I see news of my ordeal made it all the way to California.
Yes, it did. Yes, being locked in after hours at an urgent care is quite the story. And so Americans who want to scroll their phones and be entertained all across the country are going to tune in for the Nash Paradise story. Should we start there, Nash? Should we tell a quick little?
Yeah, I might as well summarize it because people had a lot more interest in it than I thought they would. It seems like, your regular, normal, everyday trip to the urgent care, got the flu, been sick for a few days, had some fever, all that good stuff. So went in, got checked out, had some tests done, did some chest x-rays, and I'm just hanging out. Next thing I know, 10 minutes goes by, 15 minutes goes by, about 25 minutes goes by, which is not uncommon. These urgent centers are very busy right now with the flu going rampant. And I was texting my wife and she's like, why don't you open the door and see what's going on? I was like, okay, that's not usually me. I'm usually just like patient guy, just gonna hang out. I trust the people around me. I'm like, cool. I open the door, walk out, and the alarm starts going off. I was like, oh, okay, this is different. And they had closed about 25 minutes earlier and they forgot about me, left me in a patient care room. So I was like, okay, this is interesting. So the alarm's going off. It's completely dark. It looks like the start of a horror movie or a zombie apocalypse going on. I'm like, yeah, I'm pretty sure, Fear the Walking Dead started this way. And, all things considered, not that big of a deal. I called the non-emergency police line, let them know, hey, I'm locked up in this here care now. They're like, oh, interesting. Yeah, we got a call for that. We've dispatched an officer to go check it out because of the alarm. I was like, yeah, I figured y'all were coming. So I wanted to let you know that I was here. And I'm not, I did not break in. I am literally hanging out in a patient room. So they took my info, said they'd give me a call when they showed up. And, they got there, called me. I walked to the front door, met the guy there. Thankfully, the cleaning crew showed up at about the same time the officer did. So they were able to get the building unlocked. And, got me out. So no big deal. I thought it was just kind of a funny story. Like, it's kind of goofy. It's definitely the type of thing to happen to me. But, next thing I knew, it started blowing up on social media. 100 hits, 200 hits. Next thing I know, 100,000 and then 500,000. Wound up doing a radio spot. I wrote a song about it that a lot of people seem to like. And so after 25 years as a professional musician, I finally got my song on the radio, and it happened to be something I wrote in about 20 minutes in my car. about getting locked into care now. So a little irony there. I'm like, I've put so much work into songwriting, and here we are with mostly AI in a song. But yeah, I got to be on the news a couple times, do a radio spot. Just kind of blew up. But thankfully, all the responses were positive, and any press is good press. And people were, thankful that I had a good attitude about it. I don't know that there's another way you could have been about it. I mean, getting mad and pissed off and angry. A bunch of people are like, "Oh, you call an attorney and sue." I'm like, dude, I lost 30 minutes of my life, and I got a ton of social media awareness on that. So it looks like a win-win to me. But yeah, that was my week. So unfortunately couldn't be here because I couldn't speak and was big sick, but definitely had something fun come out of it.
Awesome, man. Yeah, glad to hear you you escaped. You're on the mend and feeling better because the flu's definitely going around. Let's jump into the numbers because I know you're a numbers guy. I missed you last week when we talked about the Fed meeting. For those that missed it, you didn't miss much. The Fed didn't change the Fed funds rate. This was 99.5% of people expected this, and so it was pretty par for the course. I actually listened to something too last night where they interviewed Trump because Trump will go out and say a bunch of stuff, and he was like, "You got to lower interest rates now," and even he knows that the Fed's funds rate, it should remain unchanged, right? Because people asked him about that. Like Jerome Powell went out and he didn't change the Fed funds rate, and he goes, "Yeah, that was I can't remember the wording, but basically it was, it's not the right time to lower the Fed funds rate." So anyhow, here's the 30-year chart, which we've looked at in the past from Mortgage News Daily. Average 30-year fixed rate bouncing right around 7%. And anything else to add that you saw last week, Nash, besides the same old Fed speak that we normally see?
Yeah, I mean, coming back on a Monday morning market update after a, Fed presser, you'd think there'd be more to talk about on that, but there's not. We knew exactly what that Fed meeting was going to look like. No change, no really interesting notes, forward thinking, data driven. It's kind of getting repetitive now, and it's going to be repetitive pretty much all year on the same thing. But I saw some of the same articles. I'm glad that Trump has acknowledged that the Fed funds rate doesn't necessarily need to be lowered. That's not going to directly impact mortgage rates anyway. So, it's fine where it is. Now, looking at mortgage rates, it was a pretty smooth week last week. We had a little bit of improvement from that quick blip where we got up over 7.5%. Now, unchanged at 7.05 from the close of business last week. So it's got room to move up. It's got room to move down. And right now, as we can see in this chart, it's been a little consistent in the last, week or so.
Yeah, I think the only volatility we saw, and briefly saw, was inflation data came in. And for anybody who uses the fancy words like PCE, it was PCE data specifically. What's the consumer index?
So the core PCE hit on Friday, 0.2%. It was the month over month December, which came in right at at where we thought at 0.2%. That's your personal consumer expenditures, basically all of our month over month spending. So it was not going to be interesting. Didn't think core PCE was going to do anything crazy. We're really going to be watching hard on the year over year when that comes out for the January numbers, because as we discussed a couple of weeks ago, there's a lot of room to replace a much higher previous January 2024 figure on that one.
Yeah, I agree 100%. That's what, I've said, because the smart people I listen to that are paying closer attention to it than I am point out, if you want big year over year change, you've got to have the base number, last year's number, be a high one. January, February, and I think March, there's some high numbers. So being in February, this is the month when January's figures get released, and when they do, we're going to compare January of 25 to January of 24. We actually have, a high enough number in January 24 to see a big enough decrease that would move markets. And so, let's check out the data, and knowing, like we just discussed, for any of this stuff to change, there's going to be economic numbers that come out that justify the Fed doing really anything but standing pat for the first half of the year.
Yeah, and we've got a little while to wait here. It's March 19th on the next meeting. So, anything can change between now and then. If everything stays fairly consistent and data driven, this is what we're looking at. Almost no chance of a drop. There's, what have we seen since the last Fed? It's only been a couple of business days. So hard to say, but, I like that this grouping is pretty consistent with what I believe to be true. Is that we're not going to see the first Fed drop in 2025 in March. It would just be highly unlikely, in my opinion.
Yeah, what's wild is I don't always look here at the bottom to look at like the previous numbers, but this one cut, which now is just the March meeting. In the past, it would have been like between January and March, what's the chance that there's 25 basis points cut? Like a month ago, that was 43%. Is that what that says? And we're down to 15.
It's too small on my screen to tell you, but yes, I believe that is what we're looking at there.
I think that's what that number is too. Yeah, I'm also my mid 40s when vision and hearing start to go. But yeah, a week ago is even 32%, and so once the January meeting's gone, obviously there's no chance to see 25 basis points dropped in January, and so now they're saying, all right, with just the March 19th meeting ahead of us. 15%, call it 1 in 7-ish chance that they see us cutting it. But like you said, there's a lot of data that's going to come out in 6 weeks between now and then. And that's really what's going to decide whether, everything, is as expected and there's no rate cut, or holy moly, look at inflation dropped by X. And maybe we can cut, or some jobs number or something that affects us.
Yep. Let's take a look at May. I have a feeling that this is going to be, not quite what I thought. I knew that it would be trending more towards no cut. I want to say it's not trending enough towards no cut. I still don't think we're going to see a cut in May. But again, there's too much time. There's too much data. We'll talk, once we're done with the numbers, we'll talk a little bit more about the tariffs and what that means for everything. Because, we do have some delineators that could move the markets in some pretty severe ways coming up. And, with that said, all these can change in that amount of time. So the trend in probability, like you said, from 1 month ago to 1 week ago to right now, the chances of a cut are going down, which tells us exactly what the Fed thinks. Let's take a look at June, because I believe that's the longest that makes sense to have an idea of. And this is where we're starting to see more people going towards at least one cut by June, but only slightly. There's still, 38% of the contingency that's saying no cut likely. I'll be interested as the weeks go by and we keep doing this, just seeing how these numbers for June track and change over time. Are we moving to a world where it's getting more likely or less likely that we see a cut by June?
Right. Yeah. Which, lot of data points between now and then. So it'll be fluid as it always is. So if you're interested in this kind of stuff and you're looking to see what's going on with the Fed funds rate and all the stuff that's, correlated one way or another to it, stay tuned, because we'll be talking about it every single week. And more importantly, talking about how this stuff is affecting mortgage rates and real estate and the like.
Yep. So let's talk about what this week looks like, because last week was kind of a non-event with the Fed meeting, which is, again, funny to say because Fed meeting is supposed to matter. This week, we actually got some interesting things going on, and I want to go ahead and throw a pin in Friday. Friday is non-farm payrolls day. Do you remember what happened in December when we had a really low NFP figure on the analysis? And, what happened? We destroyed it. Absolutely came in crushing it over, and interest rates shot up a really significant amount. Well, look at Friday, February 7th. We've got a projection for non-farm payrolls at 170,000. I think the last time we were concerned about NFP figures, it was something like 156 or 165 was the figure that was, being forecasted. And we blew past it by like 90,000 jobs. So previous figure for non-farm payroll came in at 256,000, and now we're projecting 170,000. This is a concerning day for anyone in real estate or in mortgage. it could move things either way. If we actually came in under that, yeah, we could see things get a lot better. But man, if we blow by that figure again and we're up in the 200,000 to 240, it could be ugly for interest rates.
Yeah, for sure. And I remember you had a really good call on was it last month's number where you said, here's exactly what's going to happen, and you nailed it?
I did. And yeah, but I mean, giving myself credit for a coin flip, you know, if it went the other way, then I would have looked like an idiot. And that's the nice thing about hindsight and doing this show after these are announced. But, you know, I do think that the takeaway here as it relates to anyone in the real estate world or thinking about buying real estate is Friday is a day that we need to be concerned about. I'm probably going to be, if I like where something is before that, I'm going to lock it because I'm a mortgage broker and I've got the flexibility if I need to. I've got some outs if we lock and things get a whole lot better. But, you know, if we don't lock and we're hanging out, we're trying to wait for things to go great, Friday could be a day that could get in the way of that. We also have unemployment rate month over month for January coming in. Projection right now is just keeping consistent at 4.1%. We do have a little bit of rounding to worry about with that, but I think, you know, that's more likely to hit. Forecast is the same as the previous. So at least that's a lot more consistent anyway. Jobless claims, we're anticipating to go up a little bit on the Thursday numbers. And I think Thursday figures will give us a pretty good idea of what may happen on Friday, assuming that that the forecasts are relatively accurate for continued claims and jobless claims. In other data next week, S&P Global Services PMI, no one really cares about that or knows what that is, but it can move the bond market. And then, you know, ISM Manufacturing on Monday, February 3rd. That was today. It came in a little bit over the forecast, but no one's trading on that right now. And no one cares about that right now. What does everyone care about right now, Matt Gouget?
Everybody cares about mortgage interest rates.
I know, but what do they care about in the data? It's the T word. It's not Trump. Tariffs.
Oh yeah, for sure. You know, the funny part is, my brain had started to take notes because I was thinking about one thing before we get into tariffs is, the Fed hiring freeze, all this talk of Doge and government efficiency. I wonder if that stuff has an effect on jobs and job numbers, because as we know, like that's one thing that could move the needle when it comes to long-term rates, mortgage rates.
That's an interesting point. I'm glad you brought that up because it's something that, like, I'm dealing with it personally. I've got people that I know that work for the federal government. They're off-site. They're 1,500 miles away from their office. And when, the federal government came and said, hey, it's back to work, back to the office physically. I know these people, I've been working here for 12 years. My job is remote. Like I work from home. What do you mean back to the office? I'm not going to go to Washington, D.C. to do my job. And so there's a lot of uncertainty there for a while. And, there's not super well received by the general public as some of the details came out on exactly how, like, we like the idea of people going back to work and making sure that we're being highly efficient. That is generally, treated pretty positively. But then, getting in the nitty gritty, it's like, oh, wait, who's going to be negatively impacted by this? And thankfully, the people that I know, their particular departments were given some guidance that if they were more than, now I don't remember the exact figure, I think 100 miles or 200 miles from their office, that it was possible for them to get an exemption to not have to go to the office physically. And as the people I know are hundreds and hundreds, if not thousands of miles away, thankfully they're safe. So those jobs will still be there. A lot of discussion around the golden parachutes for some of these jobs, basically incentivizing people to retire and take severance to get out of these positions so we can become streamlined and more efficient. I do think that, what you alluded to, we're going to see that impact on the jobs numbers, but maybe not as immediate and maybe not as significant either. I mean, the government employs a ton of people, hundreds of thousands of people. Are we going to lose 50,000 people in a month? No, it's not going to be that significant. I think it's more of just a talking point right now. And I think markets react based on long-term expectations. But I don't think it's going to be severe enough that we see any kind of huge layoffs that are going to make an impact on the national numbers.
Okay, cool. Yeah, fair enough. We'll continue to watch that too, because I think it's interesting just to kind of keep that in mind as something that affects something that's near and dear to us, which is mortgage interest rates. So yeah, let's talk about tariffs, because that's another one where people see that and they're rightfully kind of confused on how does this affect me as a consumer? How does it affect, the overall economy and whatnot? So I'm admittedly not an expert on tariffs, but I'll probably read into them just so I can have some idea. What's your thoughts on all the stuff that's going on with tariffs and how that might affect the overall economy, and then more specifically mortgage interest rates?
Well, let's go ahead and break this down. Let's talk tariffs 101 here for a second. What is a tariff as they're being referred to, in the news and what we're talking about? It's a tax. It is increasing the cost of goods that are exported from one country to another. So basically, when we're fighting with Colombia, we say, all right, Colombia, we're going to put a 50% tariff on all of your exports. So now everything that comes from Colombia, the price that the U.S. distributors have to pay includes a 50% tax on that base cost wholesale for those items. That in turn means that the people importing are going to have to charge a much higher price to continue the same margin. So if you're getting coffee from Colombia for, $5,000 a ton, and now you've got a 50% tariff on that, it's costing that importer $7,500 a ton for that same product, which means as they go and, get to their distributors and figure out their cost averaging, they're going to have to take that into consideration. It means those goods cost more. When those goods cost more, they're going to be purchased less. And that's going to, basically try to push more demand to other people. And we use this as a political tool to say, well, okay, if goods from Colombia are going to cost this much more, I'm going to import my goods from Mexico that has a lower tariff, or Brazil that doesn't have the same kind of tariff. And it creates this world where, because so much of our global economy is based on the US dollar, that we can force different and unfair competition between countries to get more favorable terms. In order for us to have what we want from a particular country, we've got a lot of leverage because we do so much importing. So as it relates to the most recent tariffs, talking about Mexico and Canada specifically, there's a lot of goods that are being exported from Mexico and Canada directly into the United States. If those get more expensive, the thought is to try to drive more investment in the U.S. That's one of the principal characteristics of tariffs: make foreign imported goods more expensive. So it gives, U.S. manufacturing, U.S. cultivation, U.S. farming a chance to compete. A lot of other countries have much less expensive labor costs. Look at China, look at Mexico. And so it's cheaper to import and then to be able to sell at a lower price than using U.S. goods, which isn't necessarily good for our overall GDP. So there's always some balance here on how do we make sure that we are maintaining this global current of currency that works out in the U.S.'s favor, but also that, we're getting the policies that we want from our foreign neighbors that help drive U.S. jobs, help drive U.S. spending, and keeping that money in the U.S. instead of sending it abroad. Now, to answer your real question, what does that do for us in the economy? It's kind of a double-edged sword. It's not great for inflation. We're talking about imports being more expensive. And when things get more expensive, that's going to drive inflation up. Yeah. But if we then turn that into more investment into goods produced in the U.S., that means more money into the U.S. That means we can pay higher wages. That means people are willing to pay more for things. So ultimately, long term, that can benefit the U.S. economy. So I think that's why until these tariffs become much more severe, it's a lot of projecting. Once they're in there, I think a lot of people are expecting a pause and like a 30-day or a 1-month wait before imposing some of these. There's a lot of political maneuvering going on with them right now. Right. So as they start to shake out, we're going to see the markets respond. We could very well see some big sell-offs in the stock market. And as we get sell-offs in stocks, we're going to see purchases of bonds. As we get purchases of bonds, we're going to see the lowering of the yield. And as the bond yields decrease, mortgage rates will follow. So I hate to see, my 401k tanking, but as we see the stock market start to dip and be impacted by some of this tariff discussion, which will happen before the actual impact of those activities, it could be favorable to mortgage interest rates.
Yeah, no, that's a great take. I appreciate the quick, tariff class because
quick.
Yeah. Well, That's good stuff. And like you mentioned too, I think a lot of it, I don't know if posturing is the right word, but it's a negotiation, right? And I listened to the Prime Minister of Canada say, in retaliation or whatever word he used of your tariffs, we're going to implement tariffs on 150 billion in goods. But to your point, he said 30 billion effective immediately, the other 120 billion effective 60 days from now. You might say out loud that is, to prepare some of these suppliers and supply chain players opportunity or time to plan. But I think it might be like, let's bluff, but let's not push all our chips in the middle, right? Like let's do this portion of tariffs just to say, hey, we can play that game too, and probably some negotiation time before everything is out there on the table, 150 billion in goods. So it'll be interesting to see for sure.
Yeah, and you're 100% right. It's political maneuvering. Period. The end. I mean, it is posturing. It is leverage. And the thing is, no one has as much leverage as the U.S. in these discussions. That's why Colombia folded faster than a deck of cards, and sent their presidential plane in order to intake of migrants and immigrants that were being sent back. You don't want to mess with Captain Clementine over here. He is very serious about these tariffs and whether they're good for the U.S. or bad. When Trump says, hey, we're going to do this, you come over the top of him and say, oh, I'm going to retaliate more. You mess with the bull, you're going to get the horns. And it, unfortunately, may not be good for us as Americans. But, I find the political theater on this very entertaining. Hopefully it doesn't have huge impact for, us as Americans and for spending. We're already, kind of capped on affordability, but compared to the rest of the world, our inflation numbers, our issues that we've had coming out of COVID, they're a lot better than most other people. So I feel like we have a lot of leverage in these discussions because the things that we import, they can be imported in other places, and the convenience and looking at the North America Free Trade Agreement and the things that have been changed in the last couple decades, the direction of goods and services between Canada, the U.S., and Mexico. I feel like we have more leverage there, and ultimately this is probably going to work out favorable for the vast majority of Americans. But this is definitely going to be a topic that we're going to keep discussing, as it's going to move markets before any data-driven actions will.
Yes, sir. All right, man. Lots of stuff to continue to monitor and watch. And we'll be back here next Monday to talk about this some more. So stay tuned, because there's never a shortage of things going on, moving the market every single day. Mortgage rates change, and the market's got new things affecting it. So thanks for joining me, brother. We'll see you next week.
Yeah, man. Always love it. Take care.
All right, later, man.